Welcome everyone to another financial analysis video where we help you build your financial acumen and skills by analyzing the financial statements of famous large businesses. Today we're going to be looking at Topps Tiles and we're going to dig into their financial statement to help you better understand them and to be able to do it for yourself with any future statements, particularly those quarterly and half-year results. I'm Moeed Amin and I'm joined by Ted Wainman. So let's dive right in. Topps Tiles. So they are a well-known UK brand, and they are the UK's largest tiles retailer. And they do everything from tiles that you have in the bathrooms, kitchen, floor tiles, even outdoor tiles as well that you might have in your garden or patio. Now, this company came in as a request from one of our viewers, and 98% of the companies that we analyze on this channel are from our viewers. And stick around towards the end because we're going to show you exactly how you can do that. But Christian, thank you for your request, and here is your video. We're going to also dig into the share price of this company. Again, the information on the share price coupled with the financial analysis gives you a really, really good picture of the nature of the business and potentially where it's going. So whether you're thinking about selling to this company or investing in the business, or even if you have an interview coming up with them and you really want to sound smart, this show and this video is going to help you do that. So quick note on the share price before we move on. So if you invested in 1997 when they IPO'd, you'd be sitting on an increase of about 235%. If you invested 5 years ago, you'd be sitting on a drop of 36%. If you invested a year ago, that drop would be about 35%. So definitely been some moves in the last few years, and we'll come on to that towards the end. So let's take it away, Ted, and he will share what we've uncovered about this business and help you learn how to analyze the financial statements for yourself.
Absolutely. So good to see you, Moeed. Thank you very much. Welcome back to all of our subscribers. Welcome to any of our new viewers. So just go back to the comment from Christian. Says 10.6% divvy. So in effect, that's the dividend yield. So, that's the dividend expressed as a percentage of the share price. And that looks like quite a high return. So he's thinking, hold on a sec, this looks like quite a good investment. And then a 6.5% PE ratio. So that's the price to earnings ratio. So it's trading at 6.5 times its earnings, i.e. its net profit. And the way to think about that is just to turn it upside down. That's about a 15% yield on the earnings, and it just looks, looks quite cheap. And his question is, what am I missing? Well, I don't know, but let's go and have a look at their accounts. These are available on their website, very easy to find. Now, there are some half-year accounts, 2022 half-year accounts. We're going to focus on the 2021 accounts. And the full year accounts for 2022 will have been finished. They'll be being audited at the moment, and they will be available relatively soon. So this is quite out-of-date information. And in this annual report and accounts, we get all the information about the company and how it has been performing. What it's been up to, so who runs it and who the directors are, what the strategy is, all the different areas that it's working in, as Moeed mentioned. But we're going to focus in this presentation on the financials. So here we are looking at the income statement. We're in thousands of pounds. So turnover, that's the top line here, 228,000, that's a million. So 228 million pounds turnover. So that's what they sell the tiles for. Quite interesting. They buy the tiles for about just shy of 100 million. Okay, so you kind of get a feeling that this is quite a high margin business. So if you go into Topps Tiles and you spend £1 on a tile, the tile probably cost Topps 43p. Okay, that's a pretty high margin. 43% is the cost, and therefore a 57% gross margin. That's a gross margin. That's 131 expressed as a percentage of the 228. However, these guys do have a lot of overheads. Look at these numbers here. These are all the costs of running the business. So they've got distribution and selling costs. And then they've got more sales and marketing costs. So they've got double sort of selling costs going on here. All the other operating expenses, the cost of running the business, and then they've got administrative expenses as well. So you know, this is basically, it's a, you know, there's a lot of fixed costs sitting in this business that accounts for another 49%, leaving them with a gross profit of 18 million on 228 million turnover is about 8%. Okay, better than the previous year when they booked a loss. You remember this is in 2020. So 2020, obviously, that was kind of pandemic year, and maybe people weren't able to get down to the shops to buy their tiles to redo their bathrooms or whatever. Finance costs are actually quite high, so that's something, you know, we can we can compare these two numbers and say, well, you know, as a multiple of our operating profit, it looks fine. This is what's known as the interest cover, but obviously, if you're going to make a loss, then it becomes a little bit of a problem. So it looks to me like they do have a reasonable amount of debt, and they're profitable, so they are paying tax. Anyway, bottom line, £11 million profit on a £228 million turnover. That's a 5% net margin, which is, you know, reasonably low. So it looks like it's a reasonably competitive environment. And the real challenge for these guys is just all these overheads, this cost of running the business, which seems, you know, incredibly high. So there's the income statement. Nothing really to kind of, you know, to jump around about in there. If we go and have a look at the balance sheet, so interesting in the balance sheet. So they do have, so first of all, we're going to look at the non-current assets up here. So the non-current assets is effectively the things that we need to run the business. You'll notice that they have some property, plant and equipment, about £24 million. And then the right of use assets, and right of use assets is basically, it's the same as property, plant and equipment, only they don't own it. They've got it on some kind of lease contract, hire purchase, et cetera, et cetera. So, you know, these guys, you know, most of the, you know, if you walk into a store, for example, most of the fixtures and fittings in that store will be on hire purchase. And they've really done that in order to save their cash flow. So that's very much a sort of a cash flow a driven decision, and we'll just identify, we can get it all onto the same page, that there's the right of use assets, and on the other side we've got the kind of the what they have to pay. That's both capital and the actual interest. So these are the lease liabilities in relation to those right of use assets. So you kind of get a sense of you know what it's costing them. You know, that's a bit like, you know, if you buy a car on hire purchase, the price of the car might be, you know, 50,000, but you end up paying 70,000 included in the loan repayment as well. So those three numbers need to be read together. Current assets, very little in the way, so quite a lot of inventory, as we'd expect. And actually, interesting enough, we could do a quick back of the envelope calculation on that inventory. Looks to me like it takes them 116 days on average to sell their inventory. So these guys, I think they are not a manufacturing business. I'm pretty sure that they will be a you know, a trading business. They buy and then sell the tiles, and it takes them 116 days from the day they buy a tile to the day they sell it. Trade and other receivables really very, very small, but you know, that kind of makes sense, because if you buy it online, you're just going to put your credit card details, and if you go to the store, you'll be paying at the checkout. And then they have 28 million of cash, a little bit down from 31, so reasonable amount of cash. On the liabilities, they got their trade and other liabilities. So these are the suppliers of those tiles who haven't yet been paid. And again, back of an envelope calculation, and I emphasize this is back of an envelope calculation, suggests is about 72 days that it takes them to pay their suppliers. So if you are about to enter in negotiations to supply Topps tiles with tiles, be prepared for some tough negotiations. 72 days average payment time. And we've talked about the finance leases. Interestingly enough, though, regular viewers will kind of immediately be starting to kind of question the relationship between these two numbers. This is known as the liquidity ratio, and the liquidity ratio is a measure of a company's ability to meet its financial obligations as they fall due, which is basically finance speak for can they pay their bills on time. and they've got 66 million of current assets, which are cash or going to become cash soon, and 70 million of liabilities that they have to pay soon. So that's a relationship of about 0.95, and ideally we'd want that to be above 1. So that makes me a little bit nervous there in terms of liquidity. And then if you do what's called the acid test, which is where you do exactly that relationship but ignoring the inventory. So if we reduce the inventory from the equation, you're basically looking at how much cash they've got to pay their suppliers and their lease payments, and there's a ratio of 0.47. So in English, that means for every pound they owe and have to pay soon, ignoring inventory, they have 47p as cash, or coming in as cash soon. So these guys are really dependent on their ability to sell their inventory. So let's hope there isn't a big recession where people stop buying top styles or anything like that coming along soon. So that's a kind of that's a warning sign. That's definitely a red flag to me. And then in terms of the non-current liabilities, you'll notice actually bank loans, there's no bank loans. So they've paid off their debt, they've gone debt free, but they are just stuffed full of these lease liabilities. So they've got a lot of stuff, and all of that stuff is paid for on the nether, so to speak. So, it's not debt, but it's another way of funding this business. So I think for our purposes, we can call it debt. And if we look at the kind of the interest that they're paying, as a result of that, it looks at it's only around about 4%. So it's not excessive, but it is, that's obviously, helping their cash flow in terms of their capex. Down to the equity side, we've got the investment in the business. There's the investment. Own shares is it's relatively small. This will be, where they bought shares in Topps Tiles. And then we've also got, interesting enough here, this accumulated losses. So they're sitting on these accumulated losses from prior years. Just having a look at the movement in equity. Now, I thought this was quite interesting. This is last year. You remember that they made a loss last year. There's the loss that they made, or, the total bottom line, 8 million. And then they went and paid out dividends, which I thought was quite interesting as to why it may be something to do with the timings of those dividends, that they may be paid the dividends out before COVID hit, for example. But even so, if you're going to book a loss, you shouldn't really be paying out dividends. So that's my opinion, anyway. And then so they end up with this brought forward loss, and then they they have a profit coming in, and then really they pay no dividends at all. So that dividend yield looks to me like they maybe they've paid a dividend in this period, but it looks to me, I'm not sure where that dividend yield that Christian is highlighting comes from, and maybe we'll look at the sort of the current dividend yield. So if he's looking at a past dividend yield, then he will be looking at this number here. This is my guess, is that that's a past dividend yield, and that's not sustainable as far as I'm concerned. I don't think that they can carry on doing that. Although, having said that, maybe you look at this profit figure and you think, well, hold on a sec, maybe they are going to start paying out dividends. If they make a 10 or 11 million pound profit, they can reinstate that dividend. And I think it really comes down to the cash flow statement. So in terms of the cash flow, they are generating cash. So this is the kind of the cash they're generating. And then there's this kind of this bigger, sorry, that's their profit figure. Then we've got all of these adjustments. So you'll notice there's lots of depreciation because they have all of these assets. There's lots of depreciation going on. This is the non-cash expense. So we add it back. And so really it shows that these guys are generating lots and lots of cash. Quite interesting, just looking at the working capital, this bit down here. I thought it was interesting that this line here, just to highlight. So in the previous year, 19 million, if your accounts payable, that's the people you owe money to, if it goes up by 19 million, that means you haven't paid them 19 million, you owe them an extra 19 million. So it has a positive effect on your cash flow. And then this year, it's gone down by 11 million, which means that you have been paying them. So I don't know, those look pretty large movements to me, and whether there's sort of year-end massaging the figures going on, I'm not absolutely certain. Also, interestingly enough, that the cash generation in the previous year was very, very high, so 51 million, and I couldn't quite work out what was driving that from the loss. And it looks to me like there was a big sort of, we're not paying our suppliers because of COVID, and also just interesting, this big number here. This is the impairment of right of use assets. Okay, so just to be clear, depreciation is where you match the cost of an asset to its useful economic life. Amortization is doing exactly the same thing, but for an intangible asset like intellectual property rights or licenses or patents. Impairment is where basically you're writing down the value of an asset. So you're just saying, I've got a car, I've wrapped it around the lamppost, it's now a useless lump of metal, I've got to write it down. So it looks to me like that was a big kind of write down in the previous year. And so COVID, bad news. This is an opportunity to bury all the bad news, and they swoop everything through the books, produce this horrible loss, and then say, well, everybody else is losing money as well, then it's all down to COVID and don't blame me type of thing. And it's a kind of way of hiding bad news, and a typical of how companies will hide bad news, because they'll wait for something really bad, something even worse in kind of going on in the world, and then they can just kind of quietly say, and we've got some bad news as well, and nobody really notices. Okay, maybe I'm being cynical there, but that's certainly my experience. So anyway, they are generating cash. That's the point. So they are generating cash. In terms of investing, a little bit of property, plant, and equipment being purchased. So there's a little bit of investing, and then in terms of the financing, they're paying off their leases. So that's a kind of you could almost read that as a kind of form of investing. And then there's the dividend in the previous year, and repayment of bank loans. So you remember they went debt free. So these guys have made a real effort to go debt free in this year, leaving them with about the same amount of cash that they started the year with. So that is the kind of the key numbers for me. So I think there's nothing else to really kind of highlight. It just it's a really interesting business, especially when you've got somebody who books a loss and generates cash. This to me is kind of there's kind of warning signs going on there. So I'm not saying they're massaging the figures, but it's I'm a little bit nervous. I think liquidity is their issue. And if I give you an example, if we talk about the working capital requirement, obviously they have no accounts receivable. So if it takes you 116 days to sell a tile, and it takes you 72 days to pay for the tile, then you've got a difference between those two numbers of about 47 days, and you need to be able to fund your business for those 47 days. And they've got negative working capital, and that makes me a little bit nervous. They're not running out of cash. They are generating cash, and maybe that's why, but there's something that just makes me feel that they're just sailing a little bit close to the wind. And I did have a quick peek at the half year results as well, and no big differences. It's kind of the balance sheet is still there. The numbers are still telling pretty much the same story. So if we go and have a look at their share price, it's been bouncing around a lot. I mean, I don't know what was going on around here. Obviously, everyone decided that we were all going to, the big property boom, and we're all going to be tiling our bathrooms. And then we have the kind of the global financial crisis, and suddenly it just tanks all the way back down again. But let's focus on kind of more recent rather than the sort of the long distance past. So here is our distance more recent. So there's COVID coming in, and then kind of builds back up again. Everyone's going to be staying indoors and doing their bathrooms, and then it kind of sort of peaks back up again, and then it's just kind of coming off the boil. So here we go. We've got a market cap of 78 million. So that is a about 6 to 7 times earnings. So again, looks relatively cheap. If you pay, basically you're paying 80 million for a company that makes an 11 million pound profit, if it can carry on making that profit into the future. And the dividend yield is 10.2%. I'm not sure where that figure has been driven, because certainly they had a dividend in the previous year, but not in the year that we've been looking at. But maybe they've paid an interim dividend in this year, in which case, again, that would be driving it. So I think the answer is yes, they are cheap. They're trading at a premium to their book value, the book value, which is the assets less the liabilities in the balance sheet, the net assets, also known, which is the same as the equity. So the equity is about 26 million. They're trading at 78 million. It's a 52 million, premium, what we call sort of, goodwill. But I just, I don't know. There's something that just makes me a little bit nervous about their liquidity. I didn't really feel sort of 100% comfortable that relationship, that that acid test, I guess, and that big reliance on inventory. I just was a bit of a warning sign to me that things could go south very rapidly if they're not careful. So just the last thing to talk about, Moeed, before I stop whittling on, apologies for that, is always like to sort of see who's running these games. So if we look on page 78 of the accounts, you'll find the directors' remuneration and lots of information about the directors' remuneration. I'm going to be very, very overly simplistic and take a single number. There it is. So it's Rob Parker, and he is getting paid £683,000. Now, that's quite a lot of money, but that's nowhere near the sort of money that some CEOs are taking out of their business. We've seen, most CEOs are sitting in the millions. So either the remuneration committee or Rob himself are showing extreme restraint, which I think is definitely commendable. So well done to him. It's up, he's got a pay rise. It's a pretty nice 67% pay rise from 409 to 683. So he's probably going on some pretty nice holidays. But interesting, I always like to compare that to see what the employees in the business are getting. And if we look on page, I think it's 117. So here's page 117, and we can see the average staff costs. I'm going to use this figure down here. This is the full-time equivalents. So we've got to basically say 1,738. There's actually 1,847, but some people go, I work the morning, you work the afternoon. So that's 2 employees, but they're a single full-time equivalent, if that makes sense. So 1,738 full-time equivalents. And if we look at how much they get paid, I think we find this up here. No, we don't. We find it a little bit further down. Here we go. So there's the pay. The pay is about 58 million pounds, which works out at about £33,000 per person, and that's actually almost exactly bang on the UK average national wage. It's 20. It's the CEOs paid 20 times earnings, which is a lot, but it's not crazy. We've seen some companies where the CEOs paid 300 times the average wage, which really is getting into sort of silly territory. So it looks to me like these guys are they're paying a pretty reasonable wage. If you're working there, you're probably getting a pretty reasonable salary. The board don't look like they're stripping money out of the business, which is good. So yeah, there's my take on Topps Tiles for you, Moeed. Hopefully you found that useful and interesting and informative. Let me just go back to my little yeah, there we go, Moeed. So it's cheap. I think it's probably cheap for a reason. I think that it's looking forward. I think that there's liquidity, there's potential liquidity issues going forward. They've got good cash flow, but their good cash flow is their ability to continue to trade. And well, maybe you could argue house prices are going to go down, therefore people can't afford to move house, so they're going to retile the bathroom or put a new deck on. Alternatively, you could argue that they're paying too much on their mortgage, their energy prices are going up, they're about to lose their jobs, and the last thing they're going to do is a new patio. So all of those arguments are relevant, and I don't have a crystal ball, but this company is it looks okay. Liquidity, that's the issue for me.
Yeah, that's thank you for sharing that, Ted, and hopefully that was useful for you all, especially when you are learning to analyze the financials of a company like Topps Tiles. Now, I promised at the beginning how you can actually make a request to us, and actually it's very simple. So all you have to do is in any one of our videos, just leave a note in the comment section Obviously, mention the name of the company that you're interested in and give us a bit of context. So tell us why you're interested, as Christian has done, so that we can actually answer those questions for you on the videos. And the more interesting the context, the higher up the priority list we may put you. So do leave a note in the comment section. Don't forget, if you like this video, please hit the like and subscribe button. If you know people in your community and network that would be interested in this company, then do share this with them, and you can easily do that in the share button. So until the next video, thank you, Ted. Thank you, everyone else.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please, please, please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.